Good afternoon or good morning, since you're in the United States, everyone. My name is Piotr. I'm a new member of Carbon Tracker here, Events and Communications Officer. This is our latest webinar called Paris Maligned 2, in which we're going to be discussing how climate alignment assessments can reveal the oil and gas companies most at risk from the energy transition, as well as introduce our new oil and gas profiles. As I said, if you'd like to join, or you're just joining us now, and you'd like to go through the report in real time, then click on the QR code on the first screen, and you'll be able to download it. Moving on now to a bit about Carbon Tracker itself. We are a not-for-profit financial think tank. Our vision is a fully decarbonized global economy well before 2050. And all of our research actually converts climate science into financial risk, as you can see on the current screen now, and focusing on financial risk and reward with the aim to accelerate the energy transition away from fossil fuels by mobilizing the financial markets. Now, if you look, you can also find our work, including this report, as I said, on the website. It's all free to access and download, and we've been working with some pretty great names on screen, as you can see, and lots of exciting reports coming up as well. But moving on to today's report, we're going to be talking about, as I said, the relationship of climate alignment assessments. And joining us to do that is two great people. Firstly, Mike Coffin. He's the head of the oil, gas and mining team. Mike will kick us off with a session of about 5 minutes to give us an overview of how Paris Maligned and the other core themes of the oil and gas teams feeds itself into this new oil and gas company profile. And then second is Maeve O'Connor. She's an analyst in the oil and gas team, but is the lead author of this fantastic report. And she'll spend about 10, 15 minutes or so presenting the key points of Paris Maligned. But with that, I'll hand you over to Mike. Thanks very much.
Great. Thanks very much for the introduction. So what I'd like to do is just very briefly outline the work that we do within the oil, gas and mining team here at Carbon Tracker. Before I hand over to Maeve to go into the detail on our latest report, Paris Maligned 2, that was launched this morning. So some of you may have seen these slides before, our regular attendees, but we really like to reiterate what we're doing here. And as Piotr said in the introduction, we are an independent research organisation providing thought leadership around the energy transition and ultimately helping to accelerate that transition towards a decarbonised energy system. The work in our team, we cover 3 key research themes. So that's the financial and strategic implications of the transition, assessment of corporate climate alignment, and then thirdly, the key considerations for financial regulators and policymakers as part of a wider financial ecosystem. Now, the reason for separating those first 2 bullet points out is very much that we see a lot of transition plan analyses and transition plans from companies themselves often conflating 2 separate things. One is the demand substitution effects and ultimately the existential challenge of the shift in energy provision or the energy transition away from fossil fuel-based system. And the second is a desire amongst a whole range of stakeholders to assess how climate compatible or climate aligned company plans are and company actions are. And often these get lumped together. For example, we saw in last week with Shell's updated energy transition strategy. This is a document that encompasses both, but we do see that separation of the 2 is really important. Today's webinar will focus on that second point, the assessment of corporate climate alignment, but we have a whole suite of additional metrics and other analyses that address that first point. And so those are the key research themes that we cover, and we cover that through a range of different products. And these products are tailored for different audiences. So the first is a series of sort of written outputs. So these are reports, notes, and blogs, and we have a whole range of articles, right from blogs or full up to 10,000 word plus research reports. The second key output is analytics and data, and some of these are contained within our reports, notes and blogs, and others are bespoke. And these are a range of formats. Some of these are some, for example, feed the Climate Action 100 Plus But we also provide, there's a thumbnail there of our emissions targets analysis. So we are assessing the emissions targets of the top 25 oil and gas companies, and Maeve will touch on that later in the presentation. And we're exploring other ways to make our data and our analytics easily available through provision of Excel downloads, for example. And then finally, and refreshed for this year and for ahead of this AGM season, is our company profiles. And those cover a range of our different themes, and I'll come on to those in a moment. But before I do, I'd just like to highlight some of the other work streams that we're planning to do in the oil and gas team this year. First would be an expansion into more of a focus on downstream work, and that would be twofold. One, working with our colleagues in our automotive research team to understand future oil demand and future products, and future fuels demand, so building on the refining work stream, but also working with our colleagues at Planet Tracker around from a chemicals and petrochemicals value chain, really to try and understand and potentially counter the pivot to chemicals as an exit route for oil and gas as demand for transportation fuels weakens. So that's one key area we're looking to develop this year. We're also looking to do more work on LNG, and we continue to build on our petrostates of decline work report that we put out for Christmas ahead of COP, looking at fiscal sustainability risks and implications for sovereign credit ratings. The final piece I would flag in terms of our sector outputs was Navigating Peak Demand, which was our report on demand substitution from October last year. And we'll be looking to build on that more at the company level, looking at understanding NPV sensitivity under different paces of energy transition, really linking through to that first key research theme about financial and strategic implications of transition. So a set of metrics that assess energy transition risk in contrast to those metrics which Maeve will be presenting in a moment on climate alignment assessments. So if we move to the next slide, so I just wanted to highlight what are the company profiles. As I say, these are refreshed product for this year ahead of the AGM season. And we're publishing these on 25 of the world's largest listed oil and gas companies, including 5 of the partially listed national oil companies. And these are live as of now on our website. And as with all of our research, it's freely available. We have 10 of these published to date, and we'll be adding more over this week and through next week into Easter. They're ranged at a broad range of audiences, and there are sections of the reports that will appeal to each of those audiences there, whether it's portfolio managers, stewardship, sustainability, ESG teams, information for banks and lenders, but also relevance to proxy advisors, as well as wider society and campaigners and civil society organizations. So in terms of the structure of those profiles, there's an opening summary. Then there is a section on energy transition risk exposure. We could just click the slide on. And then their third section is around climate alignment assessments across multiple metrics linked through to today's presentation. And then the final section will be is a section on governance, including a remuneration analysis, incorporation of a summary of our accounting, audit and disclosure team's assessments, and then also a section on assessing companies' lobbying activities. So this lobbying work was provided by Influence Map for us, and we're very grateful to them for allowing us to include that within our profiles. The intention here is a holistic assessment of the company through a number of different lenses to complement some of the more direct financial and traditional financial metrics that are used in assessing these companies. So that was a bit of a whistle-stop tour through the work that we're doing in the team, some of our upcoming plans for the year, and the refreshed company profiles, which are now launched and available on our website. So Maeve, I'll pass over to you for a summary of the Paris Maligned report we launched today. Thank you.
Thanks, Mike, and good morning, everyone, or good afternoon, wherever you might be joining from. So as Mike alluded to, we often have conversations with investors in which they tell us that they're seeking a way to evaluate the climate alignment of their investments. And there are several reasons for investor demand for alignment assessment. Firstly, for lending policies. So oftentimes now banks or other financial institutions are operating under alignment mandates for their lending. Other portfolios, particularly those with a large retail or public facing arm, and who are under increasing pressure to kind of act on climate. There's also a growing number of investors who or adopting universal owner perspective out of concern of the implications of climate change on their broader portfolios. And there's also, of course, a cohort of investors who wish to be kind of sustainable, or at least to endeavor that their capital won't be deployed in a way that might be construed as kind of fueling the climate crisis. And then lastly, and I think really important to note, as even for investors who may not have a climate mandate, that alignment assessments can be used as a proxy for transition risk exposure. And so regardless of kind of the reasoning behind investors seeking alignment assessments, it really kind of means that they require a means to evaluate alignment. And that's really where we hope this report, and indeed the company profiles that Mike just described, will assist investors and to kind of ascertain what investments fit within their alignment or climate or transition risk target. So broadly speaking, if I'm to touch on the methodology, again, this will all be in the report in much more detail. But what we do for our analysis of oil and gas assets is link the IEA's demand scenario, so the APS, which is a 1.7 degree outcome, STEPS, which has a 2.4 degree outcome, with global gas and oil supply, to determine what assets are compatible with each scenario on a kind of a least cost basis. And so if I'm to frame this in kind of another way, broadly speaking, there's very limited space for new projects under the Paris scenarios. Or I should say there's very limited new space for new projects in a 1.7 degree APS scenario, which again is a looser interpretation of the Paris goal of well below 2 degrees. And indeed, there's virtually no new space virtually no space for new conventional projects in a 1.5 degree world. And I think perhaps worth noting here that the IEA's NZE, so the 1.5 scenario, is normative, i.e. it describes where it lays out a demand pathway which would achieve a 1.5 degree temperature outcome. However, the APS and the STEPS are not normative scenarios, but instead describe a demand forecast which is based on, in the case of STEPS, existing government policies, or in the case of APS, existing and announced government policies. So it's an important distinction there that when we refer to the scenarios of 1.7 and 2.4, they're not targets, but outcomes of demand forecasts. And so with that kind of brief overview of the methodology, if we're to turn back to our metrics, the first that we look at is the compatibility of companies' unsanctioned investments with the IEA scenarios. So here you can see the proportion of each company's portfolio which are compatible with 1.7 or 2.4, or indeed outside of 2.4. So to the left, with the large yellow bars, we see the companies that are most aligned. Now they've got larger portions of their portfolios which are inside a 1.7 degree scenario. And these include the NOCs and also EMI. And then on the other side, on the right-hand side of the chart, you can see those with the large red bars indicate that project options are more so aligned with the 2.4 degree scenario. So that includes the shale producers and some of the majors that are more shale focused. And I think it's also worth noting that companies do have project options which are sufficiently high cost that they're incompatible with even the 2.4 degree scenario. So those that are captured with the dark blue bars at the top. And while these projects are potentially less likely to be sanctioned, given that they are high cost, we do find that such projects are being sanctioned or have been in the recent past. And they, of course, are even less aligned than the projects that are captured by the red bars. And so if we're to move on then to our second key metric for Paris alignment, our company's production plans or production guidance or targets. The words are kind of used interchangeably. But we looked into the guidance that companies have published to kind of ascertain which are targeting particularly long-term growth. And what we found is that almost all of the cohort are targeting growth over some time frame. Some are targeting significant increases in the longer term. So ConocoPhillips are expected to increase production by about 50% at the end of the 2020s. So they'd be the least aligned in this cohort. Whereas others have published guidance more so for the nearer term that it's still targeting growth. There are several, Repsol, Shell, and Equinor, which are aiming to keep production flat in absolute terms out to the mid-2020s or 2030s. And really only BP are targeting a long-term reduction growth, making them the most aligned, at least on this metric. So we've seen future investments and production plans, which we really view as key for a company to achieve Paris alignment, as ultimately to adhere to the limits of Paris, production will need to fall. However, for this iteration of the report, we wanted to provide investors with kind of a more holistic view of company alignment. And so we've developed what we're calling our combined alignment assessment, which combines future investments and production plans with some other key metrics for climate alignment. So these include recent project sanctions. And so we have a table in the report of the 15 largest projects which have taken FID in the last 2 years, which are not aligned with a 1.7 or a 2.4 degree future. And those projects include Total Energies and CNOOC's large expansion in Uganda, as well as Equinor's Munin project in Norway, and Eni's Baleine project on in the Ivory Coast. So recent project sanctions is a kind of our third metric of alignment. And then fourth, we're drawing in some of our other work streams. So some of you may be familiar with our absolute impact series or proxy ranking table of corporate emissions targets. So we see emissions targets as a really key indicator of companies' potential Paris alignment. And we scored companies for our combined assessment based on their relative positioning in our absolute impact ranking table. So the extent to which they meet, or the targets meet hallmarks of Paris compliance. The Europeans benefit from being relatively more ambitious, and so scored higher, those blue band. And then largely it's kind of the US shale producers and also the NOCs underperform on this metric due to their targets neglecting to incorporate Scope 3 emissions. And our fifth and final metric are remuneration incentives. So we have a work stream on remuneration incentives, most recently published just a few weeks ago. It's Crude Intelligence 2. And in this analysis, we look at companies' executive remuneration policies to see what kind of behavior are CEOs and executives being incentivized to pursue. So really, in terms of Paris alignment, what we see as key is that executives are not being incentivized to grow production, either directly or indirectly. So Crude Intentions 2 breaks down the remuneration policies of companies and provides an overview of what proportion of pay is being driven by production growth. So to create our combined alignment assessment, we scored each company based on each of these 5 metrics, which were weighted, and then combined for the company to receive an overall alignment score and then an overall alignment grade from A to H. So if I need to show our results, they kind of clearly demonstrate that the industry is falling far behind what is required of them for Paris alignment, and indeed no company considered Paris aligned on the basis of our results. However, there are leaders and laggards. So BP tops the ranking with a D, which is perhaps a good indication of the performance of the industry writ large, given that nobody receives an A, B, or C. But BP's performance is due in part to its target to cut production by 2030, and that I mentioned earlier. And there are some interesting instances of companies performing quite well on some metrics, but poorly on others. Eni, for example, have the most ambitious emissions reduction target of the cohort. but falls down as it still incentivizes executives to grow production and indeed has a target to increase production medium term, like 26 or 2027. Likewise, Aramco and indeed the other NOCs perform well on future investments metric due to their very kind of cost competitive portfolios, which are largely aligned with APS or 1.7 scenario. However, they score very poorly on our emissions reductions target metric, and indeed across some others. So the results and the scores are presented in more detail in this report. This exhibit would usually have the scores within each cell, but just remove them for simplicity for the webinar. But yes, the scores themselves and indeed more granular detail on the scoring is available in the report. So I'd encourage you to download it. And for more granular detail on each company still, in turn to our company profiles, which as Mike outlined, include key company-specific assessments, both on climate alignment, so they would touch on all of the metrics that I just spoke about and would include a recent project sanctions table for each company, even if they do not appear in the table in the main report. They also include a section on governance, so around remuneration, and as Mike mentioned, on indirect and direct lobbying practice, which were kindly provided to us by Influence Map, and as well an evaluation of the company's general kind of energy transition response. So with that being said, I'll finish with a few key takeaways before I pass back to Simon for the Q&A. So what we'd really stress is that an investor or a financial institution who are seeking Paris-aligned portfolios cannot credibly invest in a company who are themselves not Paris-aligned. And I think in terms of assessing Paris alignment, analysis of future investments and production plans are really crucial for an oil and gas company to determine both their alignment but also their transition risk exposure. And as we have developed in this report, additional metrics can give a more holistic view of climate alignment. And so we've developed our combined alignment assessment. And ultimately, what the results of our assessment show are that companies are really still far from Paris aligned. However, some are better than others. So I'll leave it at that and pass back to you, Simon.
Great. May, thank you very much indeed. Just a couple of quick reminders. If you would like to ask a question, please do so. Please don't do it anonymously, simply because if we don't feel or we don't get round to it or we don't feel we have time to answer it in the way that we would like to, then we will simply follow up after this webinar. And on the screen, you can see a couple of QR codes. On the left is the report, and on the right, you can download an example of the company profiles. Now, Mike, while we're on the profiles, and before I go, Maeve, can you have a quick look at your microphone? You were slightly choppy. It wasn't massively a problem, but you might like to just have a quick might be something to do with your noise suppression setting on your microphone. Anyway, Mike, over to the profiles. Got a question here that says, how do you hope they're going to be used? Why did you put them out in the first place?
Yeah, thanks for the question. So we put them out. It was a product we used to do a number of years ago. We were then increasingly asked for them, and it felt like a gap in our product offering. We look at these metrics we look at relative rankings across individual themes, whether it's on CapEx alignment or remuneration. But actually, we're increasingly being asked, okay, we want to understand this company as just a specific company, both from a transition risk perspective and understanding diversification opportunities or not for a company, but also the degree of climate alignment. So we wanted to have a one-stop shop that actually multiple different audiences could use, and different parts of that report are of different relevance to them. But crucially, what that would do is have a company profile that can then be used to influence asset allocation decisions by portfolio managers, can be used to guide engagement with the company through the year, but also can be used, for example, around voting on resolution, ahead of AGMs. So I think those are three very clear use cases for the company profiles.
And just a quick follow-up. Why have you included governance and lobbying?
I mean, from my perspective, governance is really, really important issue, and I think there's two elements to this. One is to what extent taking executive remuneration as a specific example. It's really important that if the company has a strategy and the board sets a clear direction for the strategy, but actually they then incentivize the executives to deliver on that strategy, and individuals respond to individual incentives. So, and our key lens here is around to what extent are executives still incentivized to grow production volume, even in companies where there's a stated a desire to transition away from fossil fuel production and to reduce climate impact. And so it's highlighting that disconnect, and highlighting that disconnect is really important. And crucially, it allows governance issues are crucial for shareholders to be aware of and ensure that the companies they trust their capital are actually acting in their interests here. Why we included lobbying? Well, again, we see that as a key area of influence, and these companies have had a lot of influence historically, and so for investors to understand and other stakeholders to understand the extent to which they are pressuring and influencing government policy, whether it's around standard setters or around taxation policy, as two examples, we think that assessment is really important. Again, links through to the credibility of company actions. And similarly, we wanted to include that lobbying data, again, to make it a more holistic evaluation of governance. And that includes also the work of our accounting and audit team, looking at the appropriateness of financial disclosures.
Okay, really, let's wrap up company profiles. A follow-on question. There's quite a few of these on the market, Mike, and here's an opportunity to plug why you think, what are the biggest differences between the others on the market and Carbon Tracker's methodology. Why should our audience use ours instead of somebody else's?
Yeah, another good question. I think that the first would be that we are separating our analyses of company climate alignment from our assessments of corporate transition response. Now, I think there are, as you say, a number of different frameworks and standards and guidance documents out there, but most of them, in my eyes, consider the two as one. And I think there are some key problems with that. For example, many assume that oil and gas producers must or should become renewable energy providers. Others presume they must diversify to some extent, but there's not necessarily a reason, and it may be in investors' interests and for the benefit of the climate, for oil and gas companies to go into harvest mode, steward their existing production and the future production from their existing assets, winding down over time, but without replacement. That might be in everybody's interests. So that would be the first point, separation of climate alignment assessment from strategic response to the energy transition. The second would be about simplicity. We're not trying to, it's not about more data, it's not about more metrics, but it's about having the right metrics and metrics that crucially in our eyes are forward-looking. It's not about assessing the level of disclosure or to how many decimal places you give an emissions reading, but it's about what is the plan and on emissions, what is the plan on production and level of future investments. They're forward-looking, decision-useful metrics. And I think that's, and they are a holistic picture, and as I say, separate between climate alignment and energy transition risk.
Great. Okay, Maeve, this one looks fit for you. Asking how up to date are these? Is the data that goes into these? For example, BP recently changed their spots. So from a user basis, how up to date is the data here?
Sure. So it depends across the metrics really, because we pull in some of our other work streams. So our Rystad Energy are our provider for our CapEx, our investment data. So they are from September 2023. Our emissions targets ranking is as of August 2023, and the remuneration metrics cover remuneration policies from 2022. Crude Intentions was published just there a few weeks ago. I think as I'm speaking on this, I think there was a question from Dennis asking whether or not the data was provided by third-party providers or from our own research. And the answer is that the investments data, or the CapEx data in the CapEx chart that we showed, is from Rystad Energy, and the rest are the results of our hardworking researchers here at Carbon Tracker, scraping through the company's own publications.
Great. So it's a mixture of bespoke and third party cleaned, I guess, is the summary. Another question here from Jennifer: is there a reason that you don't use the IEA Net NZE?
Yeah, I can take that one. So really, it's because in the NZE, there's virtually no new projects are compatible with it. So, if you think back to the CapEx alignment chart that I showed, that's all on unsanctioned investments. And so in the NZE, virtually none of those would be compatible. So there's just not much real point showing it on the chart. I think where the kind of leeway or the space for new projects is in that kind of looser interpretation of Paris that is APS or 1.7.
Okay.
So
Okay.
I'll just jump in on a couple of additional points on that, which would be the aim in this assessment is to both assess a sort of an absolute level of are companies climate aligned or Paris aligned or not, but then additionally to be able to have a relative ranking between companies and actually be able to identify which are the laggards and leaders, even if none could be considered Paris aligned. And I think that's reflected in the overall gradings on a scale of ultimately their gradings is H to A. And with the lowest company in our ranking getting an H, and the top company is just getting a D. So there's differentiation, but still room for improvement. And I encourage you, as May says, to read the report for the full details. But each of those metrics is scored out of 4, and 4 would be no new projects, i.e., aligned with NZE. And then the company's getting a 1 or a 2 within the capital alignment assessment, and of course that's just one indicator that makes up the full ranking. Companies getting a 1 or a 2 is depending on the proportion of their future products that are inside APS. So the question, we do factor in NZE, but really because no company's sort of committing to no new projects, what we're looking at is the degree of alignment with that perhaps looser interpretation of Paris goals of 1.7 of the well below 2.
Okay, we've got a question from Tim, who asks, was he reading the chart from a few slides back correctly that most of the NOCs were more aligned with Paris targets?
So, okay, I'll pick up on this one, and if May, please do jump in if there's anything you'd like to add. So on that specific metric of looking at new projects, then yes, the NOCs generally are more aligned than the others. I think this really talks to the value of having an assessment methodology that considers multiple different metrics and comes up with a combined grade. And I think that effectively is what we wanted to, this is one reason for this. So we see that one of the reasons, however, that they do appear to be less exposed is because of the long tail of production from that NOCs generally have from their existing operations. And so that generally it's fewer, there's a reduced level of new investment because actually they're operating their existing projects with a lower decline rate. So on that one specific metric, they appear slightly less aligned. However, if you look across some of the other metrics, they're generally scoring weaker than their IOC counterparts.
Okay, so excuse me. So Milo is asking us to reveal a trade secret, and when he asks, what sources do you use to gather the remuneration KPIs? Can you expand on that, Maeve?
Yeah, sure. So the remuneration KPIs for companies that do disclose are to be found in their annual reports or in their proxy statements. They are disclosed to kind of various levels of granularity. And indeed, some of the particularly NOCs have quite poor disclosures. I think there was 4 or 5 that we weren't able to assess in crude intentions due to the companies not disclosing them. But broadly speaking, there is a decent level of detail to be found in the company's own reporting.
Okay, and this one's a technical question which I'm not particularly aware of. So, Mike, Maeve, I'm going to read it out straight from John. How does a company's OGMP 2.0 participation get used in the score in scoring the emissions targets on slide 20?
I'm afraid I'm not familiar with OGMP 2.0. Micah, anything to add?
So what I would say is our emissions targets is based on our analysis. It's based on the Absolute Impact 2023 piece, which is the series we've evolved, and is framed around is looking at oil and gas company carbon emissions targets. And really it's about the plans and targets rather than necessarily what they've disclosed. As we are expanding our research, and one of the things I didn't mention up top is into methane. So we would look to incorporate, as we've searched methane in a bit more detail, particularly looking at companies, the methane emissions from companies' non-operated assets, which we think is really important, so that full equity share methane targets are included. We will look to incorporate that both into the Absolute Impact 2024 analysis, but also into next year's combined ranking. So it's not directly included right now, but we hope to include that. And as I say, for us, I often say, very hard to decarbonize oil and gas, particularly for transport fuel production, but clearly you can demethanize its production. So I certainly agree it's a very important area for us to kind of continue to research.
Okay, great. And John, if you would like us to have a chat, 20-minute chat to get your idea through to us, we would be delighted to have that conversation. Back onto the assessment methodology, Dennis asks, is the assessment methodology scalable into a larger universe size, and why have you kept it to this universe and not expanded it further?
Yeah, sure. Sorry, no, go on, Mike. It's fine.
Maeve, go for
it. So I think in terms of scalability, I mean, once the data is I think the most amount of work involved is the data scraping. For some of the metrics, so the remuneration and the emissions. Well, the emissions targets they're usually to be found. So I would say yes, particularly if you're in a position where you're an investor and requesting the requisite information from a potential investee company, it might kind of cut out some of the legwork involved. And as for the universe, so we've kept our universe consistent across our absolute impact and crude intentions, and then this report, mainly to ensure that we kind of to ensure consistency and comparability, and also to facilitate the development of this combined alignment assessment. So the universe was based off the largest 25 companies based off 2022 production volumes, excluding fully state-owned NOCs and companies based in Russia. So of course we'll look to kind of evolve it over time, but I think for kind of this year's iterations of reports, it was good to keep the universe consistent.
Yeah, so I just add on that. I mean, I think for us, we wanted, as May says, to have a consistent suite of products that focused on the companies that were asked about the most. But these metrics, and of course all the individual constituent reports. So both the Paris-Maligned 2 report, but the individual reports, for example, on emissions targets or remuneration, go into the detail and lay out very clearly our methodology. So we hope others can follow them. I'd also add that in Paris-Maligned in the appendix, we are looking at around 60 companies from their CapEx, and published data on around 60 companies for their CapEx alignment. So it's a slightly a larger universe, and that's consistent with what we have historically published on those. But I would also say if there are companies of particular interest, please do get in touch, because we do have our modeling does look at global oil and gas, and something like 3,000 companies covered within that. So if there are companies of particular interest, please do reach out. And similarly, we will maybe be able to provide indications and provide further assessments of emissions targets or remuneration policies for other companies too. So ultimately, we're here and willing to hear and keen to hear feedback from the users of our products. So please do reach out.
Okay, Mike, that's great. Be careful, you'll probably get a deluge, but that's no bad thing. Andrew has an interesting question. How should investors think about companies that have both high percentages of projects that are compatible with 1.7 and also a high percentage that are in excess of 2.4. And do those companies rank highly in this report because you assume that the plus 2.4 projects are unlikely to actually move forward? Maeve, what do you think?
Yeah, it's an interesting question. So I think in terms of our methodology, we take steps as a proxy of companies' business as usual investments. Now, does that kind of assume that they are projects above steps are less likely to go ahead? Yes, but I think as an industry-wide as a proxy for industry-wide behavior, it makes sense. Of course, there are some companies who have explicitly stated that they are planning for a demand pathway that is higher than steps. And then there's also companies who have stated, who, are planning for a demand pathway that is lower than that of steps. So I think in terms of how to think about companies that have a high proportion of projects inside 1.7 and also a high proportion outside of 2.4 is perhaps kind of down to would be worth considering it on a company by company basis, and whether or not that company is kind of following a 2.4 degree pathway, in which case it's probably more likely that it's less likely that the projects in excess of 2.4 would be sanctioned. However, if it is one of the companies that foresee a higher demand pathway, perhaps it's more likely that a higher cost project would be sanctioned. And I think in our company profiles, we go into what kind of demand pathway assumptions the companies are planning on, and we also have tables of upcoming project sanctions, a table in Personal Line, but also company-specific tables in the company profiles that kind of flag large projects that are upcoming, which are outside of 2.4 or indeed outside of 1.7. So I would encourage to kind of take a look into those if it's project sanctioning decisions that is an area of interest.
Mike, anything from you?
No, I think Maeve captured it all there. Yeah, we've got those tables showing the individual products. So
great.
We encourage investors to engage on those. Okay,
so here's another a good question: is that you're building this into almost a score when you look at the combined results of these core themes. How do investors, how do investors, if investors wanted to adjust the weighting that they give to each factor, how do they go about doing that? Or can they? Or why have you put the weightings as they are? Sure. I'm looking at you, Maeve. I'm looking at you.
Yeah, so I think kind of as I spoke about in the presentation, it's really future projects that are the most important for Paris alignment at this kind of juncture, because of the very small amount or limited space that there are for a 1.7 degree scenario, and kind of virtually no space for future projects in 1.5. So I think that was our reasoning in applying a greater weighting to future investment and future production plans. I would also say that those are areas in which investors can really engage and have an influence on. Measuring kind of production from existing is this kind of in the past, so less likely to have an influence on. And then in terms of emissions targets and remuneration, I think remuneration incentives, while they incentivize company behavior, what we see is that they kind of tend to be shorter term in order to incentivize executives really to achieve the overarching production growth target. And then emissions targets, of course, are an important metric, but we would kind of see it kind of in some respects expressing production plans in a different form, i.e. if you've got a Scope 3 emissions targets that is and a Scope 3 emissions target on an absolute basis, I should specify, and that really is saying that your production will fall at some point in the future. So to that respect, I think it's the kind of first order target is the production plan and investment, and then the emissions targets kind of support the execution of that.
Mike?
Yeah, I mean, we've laid out the methodology in the report, and we of course didn't have time to show today both how we have scored on that score of 0 to 4 across each of those metrics, and then the weightings. And what if people felt that if the reader felt that we wanted to adjust those weightings, it'd be very easy to take those individual scores, apply a different set of weightings to come up with a different ranking or different grading. Well, we said that depending on their relative importance of those weights, and as Maeve said, the weightings we landed on are what we feel is the right relative ranking, relative weighting, in determining an overall score.
And following on from that, just a quick question for the analysts and model builders that are sitting on this call. If you had more time, would there be any other metrics that would immediately spring to mind that these people could build into their own model?
So we have a box in the report on other relevant metrics, and I think we've captured the key ones in our current assessment, but of course always room for kind of evolution. And I think methane, as Mike touched on, is a really important one, especially for Paris alignment, due to the fact that methane is such a potent has such a potent greenhouse gas effect. Additionally, would be like a devotion or a split of capex on pre versus post FID projects, as that would be kind of an indication of companies' intention to develop into new projects, which are obviously is behavior which is not Paris aligned. So those would be two I think of. Mike, I'm not sure if you'd have any to add.
Yeah, I mean, as I say, in the I'd say those are the two. I think the main ones that we could look to include. As I say, we're keen for feedback. The other one would be the lobbying. So we touched on how we're including that in the in the company profiles. So we could look to bring that into the overall holistic analysis. I think I'd also just stress that these very much, or reiterate, these are the climate alignment assessments. And while these do give an indication of transition risk exposure alongside kind of the core audience is looking for alignment in its own right, we are in parallel developing a series of metrics to assess energy transition risk, of which capex alignment from an exposure, transition risk exposure, production decline from a duration risk perspective, and then also remuneration around coherence between strategy, stated strategy and incentives. We'll also be looking to build that into MPV sensitivity. So say we'll have a set of metrics which are climate alignment and a sectoral electrics viewed through an energy transition lens as well.
And so we're coming to the close, and there's a couple of questions that I'd like to perhaps join together as a finale. Maeve, you did this a couple of years ago. You've done the report again, or we've done the report again. What's the direction of travel? It seems perhaps that everybody's getting a little bit worse. And do you think that is an indication that companies are effectively betting against the global delivery of the Paris goals, regardless of the consequences? Is that what the data's telling you?
Well, I think to your first point in terms of progress, broadly speaking, yeah, we haven't seen much progress. Indeed, in some cases, we've seen companies roll back targets or roll back emissions targets. So the general kind of progress isn't great. In terms of your second one of companies betting on climate failure, I think some companies certainly are, and we have kind of seen certain companies explicitly push back on, say, the IEA's forecast that oil, gas and coal demand will peak by 2030, and be fairly explicit in their corporate materials that they're planning for a demand pathway that'll very much blow through the Paris Agreement. However, now there are companies whose I'm just hearing something back in there, whose corporate actions are kind of moving towards Paris alignment. So I wouldn't say that all are the same, but certainly some seem to be kind of betting that Paris will be blown.
And I'm just going to sneak a follow-up question that's just come in and you mentioned the D word, the demand word. Some would say, they're just simply reacting to the demand as they see. Mike, you mentioned earlier on, and Carbon Tracker has historically sort of focused on the supply side, but I get the feeling that some of your work, and indeed I know some of your work, is really starting to pivot towards the demand side. Is that the key to unlock the stalemate, if you like, or reverse the decline? And what are you doing about it? What are we in your workflow? What are you doing about it? What are you planning?
Yeah, I think that's increase. Clearly, supply and demand needs to go hand in hand, and reducing both to avert the catastrophic effects of climate change. I think historically, Carbon Tracker has been viewed as a very much a supply side focused organization, and well, that's true to some extent. Implicit in the stranded asset thesis has always been that policy action and technological development will see demand substitution, which will see a reduction in demand for the products of the suppliers. So the two have gone hand in hand. But I think what we are doing is getting better at articulating that, and articulating that the suppliers are in some ways at the whims of demand change and demand substitution effects. How are we incorporating that increasingly into our analysis? Well, I think that's working closely with colleagues, whether that's in the power and utilities team or in our relatively new automotive research team, and looking at understanding their analyses. For example, the S-curve rollout of electric vehicles in different geographical areas, and at what point different parts of the world are on that S-curve deployment of this new technology. And then feeding that through into appropriate scenario selection. So yes, for our climate alignment, we're using the IEA's scenarios because those are widely recognized and widely used as reference cases. But when we're thinking about our demand substitution, our more risk-focused analyses, we're looking at a suite of different scenarios, particularly ones which better incorporate the nonlinear effects of technology transformation. So working with colleagues, use of scenarios, really questioning and using the data to drive forecasted demand that we can feed through into our demand substitution models.
Great. Thank you, May. Thank you, Mike. That's probably where we want to rest. And if you do have a chance to have a whiz around our website, I would encourage you to have a look at our automotive work. Ben and Philippa have done some work on the EV rollout and the S-curves there, and they're currently hard at work with the trucking emissions and the rollout there of the substitution of fossil fuel demand through the electrification of the heavy goods vehicles. This report, Paris Maligned, like most of our reports, is on our website, and it will be sent to you all shortly via the email. A replay, as Piotr said, will be available in the next day or so, and so will the slides. And if we didn't get to your question, or you have a follow-up question, feel free to email the team. We're always really delighted if people send in questions. And next up for us will be on April the 24th, when Lorenzo Sane, part of our P&U team, will be joined by a panel of industry and policy representatives to discuss his latest report, CCUS, Curb Your Enthusiasm. Invites will be going out soon. And the report has been, and I can tell you, the report has been the fastest report in Carbon Tracker's history to surpass 500 plus downloads. So it all is brewing to be a very interesting discussion. So thank you for your time. Thank you again, Mike and Maeve, for the presentations, Hannah and Piotr for behind the scenes. And we very much look forward to seeing you all again very soon.